You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we're going to piggyback on last week's Options Playbook radio session, and we're going to talk about Costco. We looked at earnings in Costco, and we talked about doing a butterfly in Costco. Costco is going to announce earnings today. We're taping this on the 7th of March. It's Wednesday. The markets are open. We talked about last week looking at a butterfly, setting it up. It said that we'd rather do it on the day of, so we're going to actually set up that butterfly today, and we'll talk about where it was last week, and we'll look at where it is today. So last week, when we put on the butterfly, let's recap. The market was at 192.20 in Costco. The stock was up $2 on that day. We did a 10-point wide butterfly, and it was all at the money. We did it using calls. We looked at the March 9th expiration, which is right after earnings, a few days away now, and we bought the 182.50 call, went 10 points up, sold two of the 192.50 calls, and then bought the 202.50 calls. Everything 10 points wide. Our net debit to the account was $3.80 at that point in time. The expected move was about $9. That was a week ago. The expected move has actually came down, but implied volatility has came up only because some time decay has happened. All right. So today we actually already have a big move in Costco. It's already moved down 5 points away from the 192.50 strike. So overall, it's moved down about 7 points since we talked about the trade. And I just want to point out, I went and got a quote on that exact butterfly. It was at $3.80 when we put it on. Right now, it's trading for $3.40. That's the midpoint. Those are midpoint prices. And as always with Options Playbook Radio, don't forget, we're just trying to learn here. We're not trying to make recommendations. But I just wanted to point out that since vols have came up, even though this has moved 7 points away from our middle strike, we still could get out of this trade for a loss of 40 cents. So because of the pumped up implied volatility, the fact that they haven't announced earnings yet, it's artificially inflated the total cost of this butterfly. So since we have this opportunity, I thought we'd be taping Options Playbook Radio maybe on Thursday the 8th, but it's now the 7th. Let's look at a whole new one. Let's center it right around where the current underlying is at. So we have the market right now at 186.31. And guess what? If we did a 10-point wide butterfly right at the 185 strike using calls, March 9th expiration, everything the same, we're going to buy the 175, sell two of the 185s, buy one of the 195s. Guess what? It's trading for $3.85. It's only 5 cents more than what we were looking at last week to put this trade on. And that's just a testimony as to why we want to do this the day of the trade, as close to the close as possible if you could. We got a few hours to the close here today. So 385, that's where we want to go. We're hoping that the expected move does not happen. It moves less than that. Right now, I'm showing the expected move. Let's call it 750. That's if we bought the at-the-money call and bought the at-the-money put. It's trading for about $7.50. So we want it to move less than that. And if it does, this trade should be profitable. Vol should come off. We'd be looking really solid. We have 2 days remaining to expiration on this trade. Now, I figured I'm going to stick with this theme. Costco is a solid underlying to trade, a $186 stock. We got some premium in it just because it's a fairly pricey stock. It's not Amazon or Priceline by chance, but it's a pricey stock. So I want to look at an iron condor also, and I want to compare the two, and I'm going to completely change it up. Instead of taking advantage of the volatility crunch, which an iron condor would like, I'm going to go a little bit farther out in time. That allows me to bring in more credit. The volatility crunch won't be as great and the time decay won't be as great. But if I go out further in time, Vega actually increases because there's more time premium. So a 1 percentage point move in a longer term option will usually affect the prices of the options more than a shorter term option. And it's just a simple fact that there's not as much time premium in the shorter term options. So I'm going to compare both of these because these are the way that I would look at both of these trades. Now, none of these are meant to be recommendations, and that always holds true on Options Playbook Radio. We're just talking about different scenarios, and I think this is a great scenario to compare. So I'm going to go out 45 days to the standard monthly expiration in April. That's actually 44 trading days looking on the Ally Invest option chains. We still got the stock. We're going to call it right around 185. We know the expected move is about 7.5. Let's call it 8 points. Now, that's not the expected move by April, but I don't want to be around by April. I'm going to go out and I'm going to do this trade, and I can go further out because we're using longer term options. I don't need to go right at 8 or 9 points, the expected move. I'm going to go further than that, and I'm looking to make a few dimes on this trade. I'm not looking to make dollars, which is a potential on the shorter term butterfly, but obviously a lot more risk too, because you're not going to have as wide of a sweet spot as you would on the iron condor. So let's go on out with the stock at around 186. We're going to go about 16 points down and about 14 points up, all right? Only because of the way the strikes land. So on the downside, on the put side, we're going to sell the 170 and buy the 160. We're going to go 10 points wide. We're going to add a little bit of risk here, but it's going to help us bring in quite a bit more credit. And on the call side, we're going to sell the 200 and buy the 210. So 10 points wide is our iron condor. We are going 15 points out, almost double what the expected move is on the trade. We're going 44 days out in time, and we're going to look at how this condor reacts relative to the actual butterfly that we put on. We got a little bit more risk, but we're bringing in a massive credit here in concept because we're going so much further out in time. So April 20th expiration, we are buying the 160 put, selling the 170 put, selling the 200 call, and buying the 210 call. We are getting this entire trade done for a net credit at the midpoint of $2.10. Can't always get a midpoint fill, but that's approximately where we're at. Our width of our spreads are 10. 10 minus 210 is $7.90. That's our maximum that we can lose on the trade, but we're not going to stick around. If we get this big move after earnings, we're going to close it out. So I really don't expect to lose the maximum on it. It's always a potential if you stayed all the way to the earnings, but if you get out fairly quick, you still got enough time premium in here to save you. So one of the benefits about going this far out in time is that you have so much time premium that you can do something with it. If it makes double the expected move, you can still adjust this trade. You could close out the profitable side and butterfly off the non-profitable side or roll the other side out. So this is our trade. I'm going to recap where you looked at the butterfly for Costco before earnings centered around where the stock is at. buying the 175 call, selling 2 of the 185 calls, and buying 1 of the 195 calls. And that is with the March 9th expiration to trading days. And we're going to compare that to our Iron Condor, which is 44 days out. And in the Iron Condor, we're buying the 160 put, selling the 170 put, selling the 200 call, and buying the 210 call. Net credit of $2.10 to the account for our 1x1x1x1 butterfly. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy at invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.